The euro touching its lowest level against the U.S. dollar in more than 4 years today as investors fret that the region's debt crisis could grow. But how dangerous are Europe's money problems to the global recovery and to emerging markets? Well, we've got an expert, George Hoguet. He is a global investment strategist at State Street Global Advisors. He's also spent time at the U.S. Treasury Department and the World Bank. He joins us from the CFA Institute's annual conference in Boston. George Hoguet, welcome to Bloomberg.
Good afternoon.
So give us the outlook for emerging markets. Are they still all decoupled from what's happening in Europe? What's the prognosis?
Well, you know, Pimm, obviously events in Greece and the Eurozone over the past 90 days have increased uncertainty as to the evolution of the global economy. But I continue to be very constructive on emerging markets. I think both the cyclical outlook for emerging markets and the long-term or secular outlook for emerging markets, both economies and equities, is quite favorable.
Well, George, let's talk about some of those emerging markets specifically. What is happening in China? We've learned recently that people are concerned about increases in inflation, particularly in property prices. And we know that China is very much connected to what happens to commodities. What's the outlook at China?
Well, you know, Pimm, this global recovery is being led by China and the United States. China this year will surpass Japan in nominal GDP terms as the world's second largest economy. China by itself is not large enough to take the world out of recession, but China has an increasingly important impact on Asia, precisely because consumption in China is growing so rapidly. The conduct of macroeconomic policy in China actually has been quite skillful, and I don't believe that we're going to see sharply accelerating inflation in China in the next several quarters.
Well, George, then should investors take this opportunity to, in fact, add to or even initiate positions in Chinese equities? Because the Chinese stock market has been a dreary place for investors.
Well, it certainly has. The A-share market sold at a P of about 30 about 2 years ago, and now it's down to about a PE of 16. I do expect that the Chinese later on this year will begin an orderly appreciation of the RMB. In our actively managed portfolios, we're actually modestly underweight China because of the policy uncertainty. But we do recommend that investors have 13% of their equities in emerging markets. Most investors are way structurally underweight emerging markets. And of course, in the Great Recession and the Great Panic, I would say the position of emerging markets in the world economy has been dramatically enhanced. One of the reasons being because countries like China and India have much lower levels of indebtedness than the United States.
What about the emerging market in Brazil? Would you be adding to positions there? Not only they've got domestic consumption, but they've also got a resource base.
Well, Brazil is in a tightening cycle. What's interesting in the world is that the risks of deflation, in my judgment, in the short term are growing in the developed markets, but the risk of inflation in the emerging world is accelerating. In the case of Brazil, they recently hiked rates. The fact that we're in a tightening cycle in emerging markets shows that output gaps have decreased dramatically and that world trade has increased more than people anticipated, because, you know, Pimm, last year it fell almost by 12% in volume terms.